Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us here at Ausbiz as we get across what has unfolded, particularly overnight, on global markets. Equities ending mostly in the red despite little market moving news. On Wall Street, the S&P finished flat near its record high. The Dow lost ground, but the Nasdaq gained, led by tech stocks. Nvidia shares touching a record high, lifting the company's market value to $3.75 trillion, making it the world's most valuable company. Tesla shares fell as its European sales slumped for the fifth month. FedEx shares slid after the delivery company forecast quarterly profit below estimates as tariffs weighed on global demand, rather UPS also falling. General Mills provided disappointing profit guidance, sending its shares sharply lower. And US-listed shares of cybersecurity firm BlackBerry surged after forecasting a hike in revenue. Micron Technology shares slumped about 5% in extended trade after forecasting better than expected fourth quarter revenue. And US-listed shares of BP, they initially jumped around 10% after the Wall Street Journal reported that Royal Dutch Shell is in early stage talks to acquire its London-based rival. Well, at the NATO summit in the Netherlands, leaders have backed a big increase in defence spending that US President Donald Trump had demanded and restated their commitment to defend each other from attack. This as President Trump hailed the swift end to the war between Israel and Iran and said he would seek a commitment from Tehran to end its nuclear ambitions when US and Iranian officials meet for talks next week. Meanwhile, Fed Chair Jerome Powell wrapped up his testimony before the US senators, reiterating that he's committed to keeping rates on hold while acknowledging that they are slightly restrictive and should be lower in time. Meanwhile, US capital outflows continue with foreign direct investment well below the 20-year average. The US current account deficit widened to a record $450 billion in the first quarter, some 6% of US GDP, with foreign investment inflows barely covering 10% of that shortfall. Well, US Treasury yields are slightly lower, the 2-year down to 3.77, the 10-year at 4.28%. And the US dollar fell to multi-year lows against the euro and British pound, but gained on the Japanese yen as traders consider the prospect of a Fed rate cuts. And the Aussie has risen back above 65 at 65.2 US cents. And Bitcoin is trading above 107,000 US dollars. Well, the ceasefire between Israel and Iran appears to be holding, reducing the risk of disruption to the global oil trade. Yet oil prices have recovered from a sharp slide earlier in the week as data showed relatively strong strong US demand for crude. Brent crude futures settling almost 1% higher at $67 a barrel. Copper rising almost 1%. Iron ore fell around 0.5% to $92 a tonne, and gold firmed to around $3,330 an ounce. Well, let's get across what is moving global markets with a focus on Europe, particularly in the wake of that NATO summit, with European leaders' decision to raise spending to 5% of GDP for defence. I caught up earlier with Mathieu Savary from BCA Research.
The global government, the members of NATO, are serious about increasing military spending. Now, when we think about European markets, a lot of the upside to defense spending has been already reflected in the stocks of the defense companies across the continent. And reality is a constraint at this point in time. The firms of the defense sector in Europe have underinvested in their capacity for more than 20 years. So they are actually incapable right now of fulfilling the kind of orders implied by defense spending hitting 5% of GDP. As a result, at this point in time, we believe that they have a little bit more correction ahead of them, as in reality, a lot of the additional spending in defense for the next 2 years or so is likely to also benefit US stocks in addition to European stocks. And that phenomenon is not priced in.
All right. More broadly, when you're looking at equity markets in Europe, what are you seeing at the moment? Of course, more globally, we're at or near record highs. What are you seeing in Europe?
Well, Europe is very much a reflection of what's going on outside of the continent as well. Markets are cautiously optimistic right now that the global economy has avoided the worst because Donald Trump has essentially backtracked to a large degree from the tariff originally announced in early April. It's the famous taco trade. However, this ignores a lot of problems that predate the trade war. The global economy was already on a weak footing. We were already seeing signs that global trade was slowing down, that global capex intention were deteriorating. And now that the Fed feels kind of stuck and is reluctant to cut interest rate, there hasn't been any relief. Hence, those problems still exist and are not reflected in stock prices. Secondly, it's true that the tariff rate is not as absurd as it was on April 3rd after the April 2nd announcement, but US tariff rate on average is still 16%. On Chinese goods, it's still around 40% effective tariff rate. So we still have a major impediment to global trade that is taking place from the policy of the administration in Washington. And this is not reflected at all in European stock prices. So for now, we are a little bit concerned that European stocks have room to correct. We've opted for a while now for preference for defensive stocks relative to cyclical stock, a strategy that's paid off. And we maintain this preference right now since we think that the risk to earnings in particular are underpriced.
Overall, what are you seeing in the eurozone as far as the macro outlook at the moment, given what we've most recently heard from the ECB with it's signalling a slower path of easing?
Yeah, I mean, there are two dimensions here that are important. There's the economic growth and where we stand in the policy cycle. So on the economic growth perspective, we expect activity to slow down in Europe this year because at the beginning of the year, we saw American businesses front-running tariff and European exports to the United States jumped by something like 35%. And this is ending because import orders in the United States are falling. And if we add on top of it that there is a 10% base tariff rate on European exports to the US, 25% on car, 50% on steel and aluminum, there's a lot of headwinds for European exports. Secondly, there's the dynamics in China. So China has excess capacity. We know it because there's been deflation for many years in China. And China, as I've mentioned earlier, still faces a 40% or so tariff rates on its shipments to the United States. So Chinese producers will want to diversify their markets. And this is a problem for Europe because the euro CNY trades at the top of its trading range for the last 15 years. They have a large degree of export similarity, Europe and China. And a lot of European businesses are feeling the pinch of additional competition from China, competition that is likely to grow in the coming quarters. So that is very much something that will weigh on European export and also weigh on capex in Europe, since pricing power is likely to recede. The consumer, meanwhile, is increasing its savings rate, so it's not likely to save the day. So this kind of a context, where on top of it we have deflationary pressures in Europe re-emerging, favor cutting rates. Now, the reality is also that the ECB has already cut rate quite aggressively. Rates went from 4% to 2%. So it makes sense what the ECB is doing, which is to move away from a pace of cutting rates pretty much every meeting to one where they're looking to cut rates once a quarter. It's very much appropriate in terms of balancing the fact that policy is becoming easy and the fact that there is still some downside risk to growth in the near term.
And more specifically, interested to get your view of what's playing out in France with certainly political turmoil there, but the economy looking pretty solid at this point, it would seem.
The economy of France has been doing okay, but there are cracks that are emerging. The service sector is definitely decelerating quite rapidly in France. Consumer confidence is also weak. And on top of it, the government is pressured right now. We've seen that budget deficits in France are some of the widest in Europe. The debt load of the government is very high, and the spread between French and German bonds has been widening. And as a result, the French government is trying to pass some austerity. And here there's two potential outcomes. Either they manage to pass some austerity, but as I've highlighted, the economy is starting to decelerate, which means that this is likely to really have a negative impact on economic activity. Or there is a rebellion in the Assemblée Nationale, the parliament in Paris, and we get another wave of political uncertainty as a vote of no confidence can emerge at any point, which causes the Assemblée Nationale, the current government, to fall. So either way, you have fiscal austerity coming or a wave of political uncertainty, neither of which are positive for economic activity.
That is the view of Mathieu Savary on what's playing out in the eurozone at the moment. Let's take a look at where we're likely to get going. SPI futures indicating a negative start, currently off around 0.4%. That's pretty much reflecting what we saw on global markets overnight. Now, just a reminder, our next virtual investor in the ABCs of derivatives. Did you know derivatives can be used in your SMS strategy? They can also be used for downside protection, extracting yield, and for leverage. Well, you can join our virtual investor event today to discover how to achieve the upside after learning the ABCs of derivatives. Join us from 1 p.m. Eastern. Registration is free, and if you are registered, you can watch live or on demand at ausbiz.co/derivatives. That's the global view for today. Stay with us. The Open just around the corner.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.